Hello and welcome back to my channel. So, in this depreciation series, in the last video, we saw the accounting concept of depreciation. So, today now we're going to use these concepts and we're going to solve a question. Illustration 3. We'll be doing this problem with the first method when depreciation is directly charged and a provision is not maintained. So, R. Kanitkar purchased a machinery by check for rupees 1 lakh on 1st October 2008. Another machine was purchased for only 60,000 by check on 1st April 2010. Depreciation is charged at 10% per annum by the straight line method. What is the straight line method? Every year, the same amount of depreciation is charged, okay? And it is usually a percentage of the cost. And how is the depreciation calculated in the straight line method? It will be the cost of the asset minus whatever scrap value it has divided by the useful life of the asset. So in this case, they have given us accounts are closed every year on 31st March and you're required to pass necessary journal entries for the years ended 31st March 2009, 10, 11 and show the machinery account as well as the balance sheet. Okay. So here there is no there is no scrap value given for us, and they're just saying 10% by straight line method. So we can directly just charge 10% of 1 lakh, which is going to be 10,000. Let's get started. So the first step will be we have to make a journal entry. We have to first write down journal entries, and then we are only going in this video. I'm only going to do the first bit. Okay. So this is the most basic. How are we going to prepare accounts when we have machinery depreciation and we're not maintaining a provision for depreciation? So in this video, I will only show this method. In the next video, I will show how we will do the same accounting treatment when a provision is maintained. Now, step 1. Always remember you get marks for format and presentation. So never neglect that. Okay, so in the books of R. Kantikar, he has purchased a machinery by check for 1 lakh on 1st October 2008. Okay, so what we're going to do is we're going to record the purchase entry. So usually what is the journal entry for when you're purchasing a machinery? It will be machinery account debit to bank account, right? And we will write the date as 1st October 2008. Machinery account debit to bank account being machinery purchased by bank by check. Okay. And what is the amount? It is for 1 lakh. Okay. So I'll write my amounts here 1 lakh, 1 lakh. Okay. So now we have purchased machinery on 1st October 2008 and they're asking us to pass journal entries for the years ended 31st March 2009, 2010, 2011. And I am going to assume that the books close on 31st March every financial year. Now from 2008, they have on 1st October, they have purchased machinery. So I have to charge depreciation on 31st March 2009. Hmm? So 2009. Remember, depreciation is charged annually. It is a cost, it is a charge on the value of the asset. The value of the asset will decline 31st March. And I know the journal entry. What will be my journal entry? Depreciation account debit to machinery account because that is the asset that I am depreciating. Being depreciation charged on machinery. Now the question arises is for how what is going to be the amount of this depreciation. So for this, we're going to make a working note. Working note 1. Now note, in the exam you have to show your workings. Working notes number 1. Machinery bought on 1st October 2008, rupees 1 lakh. Okay? And depreciation is charged at 10% straight line method. Financial year end is on 31st March. So, depreciation for machinery on 31st March 2009 will be charged as 1 lakh rupees 1 lakh into 10% into how many months? See, if the asset was purchased on 1st April 2008, I would calculate directly 10% of 1 lakh. However, this asset has been purchased in the middle of the year, not at the beginning of the year. We have purchased the asset in the middle of the year, and we can only charge depreciation on the time period that the machinery is in use. And in our books, the machinery has been recorded as purchased and and as being functional from 1st October 2008. So, how many months will be there from October to 31st March? For that many months only we will charge depreciation. So October, November, December, January, February, March, 6 months. So we will charge depreciation for only 6 months, not the entire 1 year. Why? Because we have purchased the asset only on 1st October 2008. Had we purchased the asset on 1st April, then we would charge entire 10%. But only 6 months in this financial year of 2008 2009, this asset has been in use, in the company for only 6 months. So I will charge depreciation only for 6 months. Okay, into 6 by 12. So that gives me rupees 5,000. Okay, so depreciation charged rupees. Ayo, this looks like a 6. Rupees 5,000. 5,000. And now the next journal entry will be the closing entry. We have to transfer this depreciation to profit and loss account. So that is the closing entry. So every year end we pass closing entries. Refer back to the first few videos where I was talking about explaining it, like refer back to the first few videos when I was explaining journal entries. We had a concept called closing entry. So every financial year end, whatever accounts we maintain, we have to close them. So some balances will go to the profit and loss account, some balances will go to trading account, and some balances which will be shown in the balance sheet. Refer back to these old videos if you're unclear about concepts. Now, depreciation is like is a nominal. It's nominal in nature, right? Because it is an expense. So we have to close the account. And how will we close the account? By transferring whatever amount is there in depreciation to profit and loss account. Every year end, we will close depreciation account. We will transfer it. So, अरे वाह, Yeah. Profit and loss account. Profit and loss account will be debited. Why? Because depreciation is an expense and depreciation was first in the debit column. Now, if I want to close the account, I will have to put it on the credit side, right? So, profit and loss account debit 5,000 to depreciation account. My D is looking like a P. Don't get confused, people. Handwriting problems. Okay. Being depreciation. Are you being depreciation transfer to profit and loss account? Okay. Okay, so this was for the year of 2008 and 2009. Now, anything else happened during. Okay, so on in the year 2009, 2010, the year 2009, 2010 will start from 1st April 2009 to 31st March 2010. Okay, so no transactions happened in the year 2008 and 2009. So we will directly just charge depreciation on the year end. So in the year 2010, 31st March. Now again we have to calculate depreciation. Note, depreciation is charged annually, right? So depreciation account debit to machinery account. And this time how much will the depreciation be? Full 10,000. Why? Because the asset has been with us in the company for an entire accounting period. So we will charge depreciation for all the 12 months, and depreciation is charged at 10% of 1 lakh as per straight line method. So 10% of 1 lakh is 10,000. Hence we'll record it as 10,000. Being depreciation charged on machinery for financial year 2009 2010. Okay. And अभी इसका closing entry we will pass. 31st March. Profit and loss account debit 10,000 to depreciation account 10,000. Being depreciation transferred to P&L account. Okay. Okay. So next what has happened on 1st April 2010, another machinery was purchased for rupees 60,000. So we will record that purchase. How will we record it? And this is in the year financial year 2010-11. So 2010, anyway, this is 2010. So 1st April, machinery account debit 60,000 to bank account 60,000. Being machinery purchased. We had to make accounts for 3 financial years. Okay. So one was 2009, 2010, 2011. So now we are in the financial year 2010-11. 1st April, we have purchased the machinery. Now again, we have to charge depreciation. So it will be financial year 2011, 31st March. Depreciation account debit to machinery account, being depreciation charged on machinery. And for this also we will have to do a working note. Working note 2. So how much would the amount be? Now we have two machineries. So depreciation on machinery 1 is rupees 10,000. Okay, straight line method 10%. Now depreciation on machinery 2, we have purchased it at 60,000. So 60,000 into 10%. And see, we purchased it on 1st April. So it's been with us for all 12 months. So this depreciation will be only rupees 6,000. So total depreciation is going to be 16,000. And that's the amount that will come over here. I hope you have understood. We have to do cumulative depreciation. So on the first machinery that we have purchased, we'll have to write that amount. On the second machinery also that we have purchased, we have to calculate depreciation and put the aggregate amount. So 16,000, 16,000. And now we will have to pass the closing entry, 31st March. So profit and loss account, debit to depreciation account. 16,000, 16,000. Being depreciation transferred to P&L account. This is for the financial year 2010 and 11. And with this, we have completed our journal entries. We've written the journal entries for the year financial year 2008, 2009, 2009, 2010 and 2010, 11. And now they have asked us to show the machinery account as well as the balance sheet. Okay, and here in this case, we are not maintaining provision. So let's get into the machinery account. How we have to follow a ledger. We have to make the ledger for machinery account. So we will follow these journal entries that we have written. We will follow here. Let's make the journal entry the account. So on 1st October 2008, we have purchased a machinery. So we will write the machinery to bank journal entry here. 2008, 1st October. Machinery account debit to bank account, rupees 1 lakh. Now, in 2009, which is the year end of 2008-2009, on 31st March, I am going to charge depreciation. So, by depreciation, working note 1, rupees 5,000. Then, 31st March, by balance carried down, I will have 95,000. Okay. So that gives me here total 1 lakh and 1 lakh over here as well. Now we have to make the accounts for the next financial year. which is 2009 2010. In 2009 2010, nothing happened. Only we'll only have the depreciation entry. That the second asset that was acquired is on 1st April 2010. So 1st April 2010 will come in the financial year 2010-11. So in the financial year 2009 2010, as such, no acquisition is happening. So we will only charge the. We'll first write the opening balance. To balance brought down 95,000. Then 2010. So closing entries 2010 31st March by depreciation account 10,000. Then we will do the closing. We will do the balancing of the account. 31st March by balance carried down. So the difference will be 85,000. 95,000 minus 10,000 is 85,000. Here my total will be 95,000. 95,000. Now the next accounting period. In the question they have told us that 2010 1st April. So first I will write my opening balance. So to balance brought down 85,000. Also I have purchased a new machinery worth 60,000. So to bank account, and in brackets I'm going to write machinery 2, so that we have the difference, like the breakup, like machinery 1 machinery 2. So that is worth 60,000. Okay, now the transaction has happened in relation to machinery in the entire year. So we will for the closing of the year, which is on 31st March, I will charge my depreciation 2011 31st March by depreciation. And my working note 2 will give you you can mention the working note 2, or else you can even write over here M1 plus M2, which is 10,000 plus 6,000, 16,000. And the next will be my closing balance. So by balance carried down. Now what is my new total? It will be 1,45,000 minus 16,000, which gives me 1,29,000. So that is the total amount, 1,29,000. But machinery 1's value will actually be 85,000 minus 10,000, which is 75,000. And machinery 2's value will be 60,000 minus 6,000, which is 54,000. The total of these both is 1,29,000. Now here my total will be 1,45,000, 1,45,000. Now in this sum, they have only asked me to prepare the account for the financial years of 2000, for the years 2009, 10 and 2008, 2009, 2010 and 2011. And that is what I have done here. In 2008, we acquired the machinery M1. We charged depreciation at the year end, carried forward the balance to the next year. Then on that balance, in that accounting period, we charged the depreciation on straight line method 10,000. Then in year 3, another asset was purchased, the machinery too. We've shown that entry, as well as we have charged depreciation on both the first machine as well as the second machine. And the balance whatever is there has been mentioned, and we have also mentioned the closing balances of the individual machines. So that means M1 is now worth 75,000, M2 is worth 54,000. And of course we have to and since they have said 2011, so to complete the sum, 2011 1st April to balance brought down 1,29,000, M1 75K, M2 54K. So that is our machinery journal. Next, they have asked us to prepare balance sheet for these 3 years. So let's just do that now. So now in our balance sheet, we were going to, this is just going to be an extract. This is not the proper balance sheet. So for the first financial year, as at 31st March 2009, my machinery is worth 1 lakh less depreciation. So I'm going to directly deduct depreciation, less 5,000. So that gives me a value of 95,000, right? Then for the next financial year, if you're a bit confused, no, you can verify the balances with your machinery account, the ledger. You can see the ledger and you can cross verify. As at 31st March 2010. Now, what is the opening balance of my machinery? I didn't know digital pens also can run out of ink. Why is this annoying me? 95,000 less depreciation of 10,000. So the closing balance will be 85,000. So you can check this in your ledger as well. Here, see, 85,000 the closing balance for the year 2009-2010. Now the final year. This is as at 31st March 2011. Machinery. You have M1 which is worth 85,000, and you have machinery 2 which is worth 60,000. So that gives me a total of 1,45,000. And now from this I will deduct my depreciation less depreciation of 10,000 and 6,000, which is what? 16,000. Gives me a total of 1,29,000. So this is my balance sheet. As at 31st March, my balance is 95,000. As at 31st March 2010, 85,000, and 2011, 1,29,000. So I basically just picked up figures from my ledger account. So for depreciation, you just need to be very confident. I mean, in every question, you're not going to be asked to prepare a journal, okay? You will directly be asked to make a ledger. Since this is our first question, they have asked us to make a journal entry, but in your exam, you will directly be required to create your ledger. You'll be asked to make a machinery ledger and then make the balance sheet, an account for depreciation also. So you'll have to show the depreciation ledger also if they ask. This is the first question. I hope you have understood, and if you have any doubts, please feel free to write to me in the comments. I will get back to you. If there is something which you haven't understood, mention it in the comments. And yes, this is all for this video. In the next video we are going to see the same question. We will solve it, and in this case a provision for depreciation is maintained. So in this example, provision is not maintained. We're directly charging depreciation. But in the next video, we're going to see the same problem, how it is going to be treated when a provision for depreciation is maintained. So with that, I am signing off for today. Happy learning, keep learning, and goodbye.